Hi, everyone. My name is Mark Ristic, Senior Instructor here at Corporate Finance Institute. Today's course is on a topic that's extremely important to any financial planner, investment advisor, or portfolio manager, and is applicable to many other individuals in this industry, whether you're just starting out or have years of tenure under your belt. Before we jump into the course, let me tell you a few things about myself. I've been working in the financial services industry for a large Canadian financial institution for over 15 years, and I've got a background in retail banking, wealth management, and capital markets sales and trading. Over the course of my career, I've worked very closely with high net worth individuals and families and the advisors who manage their money. And along the way, I've learned a ton of things that I'm excited to be sharing with you as you progress in your own career. With all that said, let's get into today's course. The main topic of today's course is the equity allocation in your client's portfolio. Or, better put, how to choose or create an equity model that you can use with your clients. Now, much like many of the other courses that we've spent time on together in the FPWM program, today's course will cover a number of discussion points that are geared towards practical use cases so that you can take what you've learned here today and apply it to a real wealth management practice and real clients. That's not to say that we're not going to get into some of the more academic fundamentals that underpin this topic, but I want to focus on building your hands-on skill set so that you can win business, grow your book, and help your clients meet their goals. By now, you've become very familiar with the FPWM advisor-client journey, which is CFI's roadmap to successful wealth management client engagement that you can look to when managing your practice. While choosing or building the models that you're going to work with isn't a specific step on the journey, it is something that you're going to need to do before you hit the third step, which is generating a wealth management solution for your client. While managing your models is an ongoing process that you're going to do throughout your career in wealth management, choosing or creating your initial set of models is something you'll need to do prior to onboarding your first client. The first question that this course will answer is the most obvious one. Why are equity models important for a wealth manager, and how are they significant to an advisor's practice? Well, before I answer that, I'd like to quickly plug two of my other courses. The first is called Understanding Asset Classes and Financial Markets, and the second is called Retail Portfolio Management. If you haven't yet completed those courses, I highly recommend you do so before proceeding. We're going to touch upon concepts that were introduced in those courses and pick a few things up where those courses left off, building a more comprehensive advisor toolbox. So with that said, let's get back into it. You should recall from previous courses that part of the client onboarding process involves making an assessment of a client's risk tolerance and investment objectives. This is something that must be done for every single client. Additionally, based on these assessments, you, as the advisor, must determine a strategic asset allocation for each of the main 3 asset types for the client's portfolio. As a reminder, these asset types are cash and cash equivalents, equities, and fixed income securities. Now, along with these strategic allocations, you'll also want to document a tactical minimum and maximum allocation for each asset type, which will give you some flexibility in terms of how you want to tilt your client's portfolio based on market conditions, client need, or other factors. All of this information is documented in the client's investment policy statement, or IPS. Let's refresh our memories a bit by having a look at an example in the next lesson. We'll see you there. For this particular client, the strategic target allocation to equity is 45% of the value of the portfolio. The allocation to bonds is 53%, and the allocation to cash is 2%. For the sake of this course, let's keep our focus on the equity allocation only for today. Now, the advisor has given themselves a wide tactical allocation range, spanning from 35% to 70%. What this means is that if the advisor is bullish on equities, they can tactically allocate more of the client's capital, up to 70% of the portfolio, to equities in order to capture more upside. Similarly, if they want to protect the portfolio a bit against a down market, they can lighten up on equity exposure and add more exposure to the other two asset types. So, with that example reviewed, the question now becomes, if the client is investing 45% of their portfolio into equities, what exactly are they buying? The answer is your chosen equity model, or a series of your models. So, what exactly does that mean? A model is loosely defined as a diversified group of assets designed to achieve an expected return with a corresponding risk. Investing in a model gives your client exposure to a basket of equities across multiple companies, industries, and even countries, while diversifying away most of the unsystematic risks. Typically, models achieve this by including a number of individual equity positions, often at least 25 or more, and frequently try to capture exposure to multiple sectors. Equity models come in many different forms, but the majority of models that are created for retail or wealth management clients can be grouped into three main categories: fundamental models, technical models, and quantitative models. Let's spend some time discussing these three main types and what differentiates each methodology from the others. First up are fundamental models. Fundamental equity models are built or created using fundamental analysis, which is a term that you've probably heard before. It means that the individual equity positions in the model were selected after an analysis was conducted on each company to evaluate its intrinsic value. When an analyst has determined the intrinsic value of a company's stock, they can state whether they believe the share price to be overvalued or undervalued. If a stock is deemed to be undervalued, an investor can buy that stock or take a long position and hold it until its value rises to the predicted intrinsic value, collecting dividend income along the way if applicable. The increase in share price that the investor would benefit from here is known as capital appreciation. And any capital appreciation plus dividend income that an investor generates from holding a position represents their total return on investment. Portfolio managers or analysts that create fundamental models will look at the projected total return on a wide range of equities and then use principles such as company performance, financial health, and economic indicators to help them determine whether or not to include those positions in their model and how to weight their model by company, sector, and geographic region. There are a number of metrics and key concepts that are used to construct a fundamental model. Let's run through them quickly, starting with earnings and profitability, which involves analyzing a company's earnings, revenue growth, and profit margins. Analysts will look at metrics like earnings per share, return on equity, and gross profit margin to gauge a company's health. Next are valuation ratios. Fundamental models often consider ratios like price to earnings or PE, price to book or PB, and price to sales or PS. to determine whether a stock is priced attractively. These metrics are determined by conducting an analysis of the company's financial statements, the income statement, balance sheet, and cash flow statement, which are the source of data for all things financial for a publicly traded company. Earlier, I mentioned dividends. For income-oriented investors, the dividend yield is an important factor and may play a role in determining whether or not a stock is included in a particular model. Business climate and positioning within an industry is another thing to consider. A company's competitive position within its industry is vital, and assessing a company's market share, brand equity, and barriers to entry in its industry are important when determining model inclusion. Let's continue with a few more key concepts that are taken into consideration when building a fundamental equity model. Management quality is a big one. The competence and track record of a company's management team can impact its long-term prospects considerably, and often, management's ability to execute strategies and make sound decisions are taken into account by analysts when model building. Along with that come other qualitative factors. Some analysts will incorporate things like corporate governance, sustainability initiatives, and social responsibility efforts into their decision-making process. Think about a company like Apple, a one-of-a-kind, innovative tech company that's famous for not only its industry-leading products, but also its visionary leadership in the late Steve Jobs and his successor, Tim Cook. Leaders with their kind of track record give investors comfort. Along with all of this, risks need to be taken into account as well. Fundamental models aim to identify and quantify risks associated with each position, including operational risks, financial risks, and market risks, with the goal of diversifying away as much of that risk as possible. Analysts will also compare a company's fundamental metrics to those of its industry peers in order to gain a better perspective on its relative value. This is helpful for sectors like financial services, where there are dozens of competitors and only the best risk-adjusted opportunities are selected for model inclusion. All in all, fundamental models are the most commonly used type of model in wealth management. And so you as an advisor will really benefit from familiarizing yourself with this type of investing. Part of that process includes getting comfortable with the value proposition that fundamental investing brings to a portfolio, and keeping some of the proof points in your back pocket when discussing and pitching your wealth management services to prospective clients. Let's run through a few of those now. First off, you want to highlight that fundamental models will give clients access to invest in high-quality businesses with strong moats, led by skilled capital allocators, and you want to position your model as something that was built by a business analyst, not a stock market speculator. These are long-term investment strategies that create value over a 5 to 10-year period via compound growth, not a swing-for-the-fences strategy that will make clients rich quickly. Risks are inherent to equity investing, but diversification is a key benefit to model-based investing. And you're going to want to mention the thought and rigor that goes into risk mitigation to put your clients' minds at ease. Lastly, make sure to differentiate your model from simple index investing. Communicate to clients the tactical changes that can be made to your model and their portfolio as you capitalize on the ideas that you have the highest conviction in. All of this will help you underscore the value that your model brings and ultimately build your book with new client onboarding.